The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bit of a breather from that breakneck rally as investors eye a busy week ahead. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. And of course, it feels like things have definitely amped up in terms of geopolitical headlines.
Oh, wow. That's the understatement of the day, isn't it?
All right, let's take a look at how things are going in the equity markets. You have the S&P 500 down 0.5%. This is the biggest drop in 3 weeks, with both stocks and bonds in retreat mode before key inflation data this week. You have yields rising across the curve, especially at the long end, the 10-year now at 4.19%. The ETF tracking big cap Chinese stocks losing 8% on the day. This is, or I should say, gaining 8% on the day. And this is after leaders in Beijing signaled bolder economic stimulus in the form of looser monetary policy. And those comments are helping to lift oil prices as well. WTI gaining 1.6%, earlier gaining as much as 2.5%, Romaine.
Back to some of those geopolitical issues later in the program. I do want to start with U.S. stocks and that pullback that we are seeing today. And you really shouldn't be too surprised by it, given the extended positioning that had pushed the S&P to that 57th record last week, but also pushed it into overbought territory for the first time since mid-July. The latest CFTC data released Friday showing asset managers clinging to the largest net long positions since at least the pandemic-related bottom bounce back in 2020. However, more and more Wall Street strategists are still saying buy these dips, as they say the next round of this rally could be just as powerful as the last. Oppenheimer CIO John Stolfus out with a note saying the S&P should reach 7,100 by the end of next year due to a strong economy. He's not suggesting paradise, just that this market can continue to climb that wall of worry, something his peer Chris Harvey echoed earlier in the day.
And what we're talking about is risk is going higher. And that's true. But when risk goes higher, equity markets also go higher. So I think one of the things that we've said, and the title of our outlook is Good Year, Bad Vintage.
And we should point out risk appetite not only rising among traders, but also in corporate C-suites, at least as evidenced by the barrage of M&A deals lining up on the tarmac. That includes Omnicom and Interrepublic's $36 billion deal to create the world's largest ad company, a more than $6 billion bid by Apollo-owned packaging firm Novalex to buy Pactiv Evergreen, Arthur Gallagher's $13 billion bid for insurance broker Assured Partners. And if that wasn't enough, how about those rumors, Scarlett, that Mondelez is exploring a purchase of Hershey?
Yeah, didn't they do this a couple years ago and didn't go anywhere? All right, well, going back to what you said earlier, it is all a reflection of the bullish sentiment out there. Romaine, you mentioned positioning by asset managers. Look at the bottom panel here. That tracks the record high positioning in S&P futures at the end of November. Every time it surpassed, the net long surpassed 1 million contracts, we've circled it at the top to show you where the S&P 500 was at the time. We're now at the most bullish level since just before COVID struck in early 2020, thanks to a combination of Fed easing and post-election excitement animating those animal spirits. The question now is whether U.S. stocks have already pre-traded the political tailwinds expected in 2025, similar to the run-up that we saw in 2017.
It's a good question, and one that we're going to pose to our first guest as we kick you off to the close here on this Monday afternoon. Earl Davis is head of fixed income and money markets over at BMO Global Asset Management. And Earl, I'm sure you've seen the animal spirits in the market, certainly here in the U.S. And I am curious, I feel like a lot of the things that have sort of propelled these animal spirits at the same time often carry some of the risk that we're all worried about, at least when it comes to politics and the implementation of new policies. Are you bullish?
We're constructively bullish. And the reason why I would say constructively and now outright is like our highest conviction view is volatility. We expect to see volatility. And typically when you expect volatility, you don't want to be long carry assets. But we feel it's different this time from the perspective that your daily and monthly and weekly volatility will be the same as it was in 2024, 2023, but your annualized volatility will be less. So what does that mean? It becomes a perfect carry environment. But to your point in looking at the S&P and where we're priced now, we're almost priced to perfection. Not to say we can't stay up here, but for that reason, we're not max overweight long risk assets. We're just overweight long and waiting for any pullbacks to add.
When you look at risk assets, and for that matter, even some of the safer assets, relatively speaking, in the fixed income space, is there enough of a risk premium built into current market pricing?
That's a great question. Based on history and looking back, you could argue no, because we're at the tights we've seen in years. Having said that, we are seeing a transitional government come, not more than a transitional, a change in policy coming in with the Trump government, which is pro-US and pro-dollar, pro-growth. So what does that mean? It means for any international dollars have to increase their exposure to the US. And in doing so, they buy US dollar assets. So when you just look at the basics, take it back from where spreads are to supply and demand, there's going to be more demand and static supply. So for that reason, we can see things going tighter. But again, it won't be a straight line tighter.
Which assets, Earl, are they looking to buy? Are they going into equities? Are they going into the world of fixed income? Or are they choosing to put money in money market accounts, which, of course, have maintained their balance near record levels?
All of the above. But we do see our preference, obviously, is from fixed income, not just and the reason why our preference from a fixed income, not just because we're biased, but because you're higher up on the capital structure. You have more protection in case things do turn around and go lower. But part of the reason we do like US dollar assets and especially fixed income and riskier assets is because not only do you have international buyers coming in, but you have a record amount in money market funds. And if you look at the return of fixed income assets over the past year, it's been positive, depending on where you are, anywhere from 5% to 10% positive in regards to the total return in the past year. That's actually more than you're getting in money market accounts. And I think that continued with further easing will bring more money into fixed income. And that's why we think the demand is going to overwhelm the supply, which is why we do see tighter spreads going forward.
You make a good argument about the returns being better outside of money market funds, but that doesn't seem to have moved much of the money out of money market funds either. What is it that people need to see before they start deploying some of that money?
Record highs on the equities, which is what we're seeing. So that's why we are partially long now. And they say partially waiting for pullbacks to buy. But we do feel strongly that there's two things that will happen. Once you get past CPI this week, we do believe you'll see a grind tighter in spreads, which means risk assets get priced higher because the markets become more illiquid, can't handle the buying that comes in. And then we do believe starting in January, after everyone looks at their annual returns and see that we're both positive overall and positive on equities and fixed income, they will want to put more money to work in risk assets. So we expect to see that retail money start turning into fixed income and other risky assets in January and the first quarter of next year.
So no real competition between how attractive those assets are. You think the allocations will be relatively even, at least based on normal allocations?
Yeah, and another reason why we like fixed income, despite how tight the spreads are, is the absolute return is still good. The absolute yield, all-in yield as they call it, which is your treasury yield plus your credit spread. And when you look at that, let's say it's 5 to 6% for very high quality IG corporates, that's above inflation. So you're going to not only are you earning that return, you're earning a real return. So you know you'll have more money in your pocket at the end of next year than you did at the beginning.
I am curious. We only have about 30 seconds left. But Earl, I am curious from the corporate balance sheet side of this. We talk a lot about investors taking advantage of this market, but we're now starting to see corporations look at interest rates, look at borrowing costs, and more important, look at risk appetite and realizing this is an opportunity for them to either bolster their balance sheet or do deals. Are you seeing something similar with the folks that you interact with?
Yeah, and we do anticipate that to pick up next year on the margin, just because I think it's pretty much being cemented. We're in a higher for longer environment in regards to your longer dated bond yields. So once you know your higher for longer environment, it makes corporate treasurers more comfortable issuing 5, 10 and longer dated bonds, and we expect to see that come to the forefront in 2025.
Earl Davis, head of fixed income and money markets at BMO Global Asset Management. We thank him. We'll catch up with him again soon, I'm sure, as we continue to count you down to the close here on this Monday afternoon. A big day for M&A deals taking center stage with several major announcements today. And that includes, well, some rumors about Mondelez, a possible acquisition of the U.S. chocolate maker Hershey. The potential deal would create a food giant with a combined sales of almost $50 billion. It's one of several deals that have been bouncing around today, including in the insurance space, the packaging space, as well as advertising. Crystal C. joining us right now, who covers everything M&A for us here at Bloomberg. Crystal, you've been a busy person today. Let's start off with Mondelez, because this is the one I think is catching everyone's eye. A tie-up with Hershey's, I feel like we've been here before. What's different this time?
We've been here before.
Yeah.
We've been here in 2016, quite recently. What is different this time is the environment has changed. The environment of cocoa prices has changed. It's reached a really high price compared to when this deal was attempted in 2016. And the consumer behavior has changed. In 2016, Ozempic didn't exist. GLP-1 is a big subject now, especially for food companies. If you look at the confectionery space, the snack space, it's something that CEO are thinking about constantly, that with the decrease in demand for these not so healthy snacks, how are they going to carry on the growth? And that one way would be to potentially do inorganically through an M&A. So this is one of those deals where scale really makes sense, and we think that this could be why this deal is being explored now.
Scale makes sense. Who has the leverage here?
So this is a really interesting situation because Hershey's Trust actually has a very big voting rights within Hershey. So they own almost all of the Class B share, giving them like the veto right essentially to any transaction or any buy that they do not like. So any deal that happens needs to have the blessing of the trust. And that is one hurdle that Mondelez will have to jump through, or any suitor will have to jump through. And beyond that, because of the structure of this deal, the Pennsylvania Attorney General, which will be a new person in the coming administration, will also have to sign off on this deal. So all in all, there are some regulatory hurdles, there are obstacles with the company structure, and then you have the market sentiment. So it's not an easy deal. So the 2016 rerun may or may not be successful, but the scale play is there.
Well, it's interesting you talk about the change in environment, because this kind of brings us to another deal, the other one that everyone's talking about, and that's Omnicom and Interpublic. Of course, an actually announced deal, roughly $30+ billion, a deal that they even said pretty much they probably wouldn't have gotten done had they brought to the table a few years ago.
That's right. Like a lot of these deals that have been put on the back burner because of a not so friendly antitrust environment are being revisited right now with the expectation that the new FTC is going to be much friendlier for M&A. The Trump government had already said they're pro-business, they're pro-deals, but the FTC turnover hasn't happened yet. So we're just really kind of currently banking on the expectation that it will improve, but whether that change is going to happen like quick enough for some of these deals to happen, we don't know that yet. But some of these situations, like the Mondelez, is quite preliminary. So by the time it happens, it will be in a new administration. But there are also like uncertainties around that.
Yeah, in this case, Omnicom has already agreed to buy Interpublic, so that is a done deal insofar as the two sides have agreed on it. Crystal, really appreciate your joining us, giving us a recap there of some of the big M&A headlines. We want to stay on this Omnicom acquisition of Interpublic and bring in Mark Douglas. He is CEO and president of Mountain and our go-to expert on the advertising space. Mark, you heard what Crystal was saying about the deal going through this time and how the environment has changed. I'm curious from where you stand because of digital advertising and the role of AI. Is this a defensive deal that Interpublic and Omnicom basically had to do to stay relevant?
I think it absolutely is, but it's not even just the role of AI. The way to think about it is that these big holding companies want to focus on big customers. So that's today's emerging company is tomorrow's big enterprise company, except today's emerging company, almost all of their marketing is digital. It's all Google, Meta, even for television, Mountain Performance TV. So these big holding companies are getting cut off from their future customers because they're not used to working in a more traditional media environment. And so the only choice you have then is to basically consolidate for growth because you're not going to get the same kind of customer funnel you had in the past.
So the big firms need more customers, but they also need different customers. Wouldn't they be better served by buying smaller advertising agencies like Mountain, for instance, as opposed to other big ones like themselves?
Well, Mountain is a tech company, so we wouldn't be a candidate. They could buy smaller companies, but they're just small agencies, I should say. But honestly, they're just not good at it. I mean, these companies were built on linear television. That's another, market that is challenged with the move to streaming. They're built on brand advertising, and that's a market where you don't see growth. Procter & Gamble, which is one of the biggest brand advertisers in the U.S., they're not increasing their budget. And so you're constrained by my existing big customers are not spending more, and my future customers are not doing what I'm good at doing. So they are going to have to become more tech enabled, and that's the ultimate path, not to getting more revenue, but to getting more profitable with the revenue they can retain.
Well, that's what I'm curious about, Mark, as to how this tie-up really ends up being accretive. I mean, they're going to have to cut a lot to get there. And it also raises the question, I'm going to pose this to you, and I know you kind of compete in this space to a certain extent, but in the old days, when you talk about these advertising companies, you were basically hiring creatives, almost full stop. And now we've seen how these companies operate, or at least the ones that are successful. Obviously, you said much more automated, much more technology driven here. What is that hiring going to look like at a combined Omnicom Interpublic to get them to that level where they do have the technology chops?
Yeah, I mean, I think it's going to be somewhat back to the future. I mean, a lot of these companies are very dependent on their media buying for their revenue and their profitability. That's getting more automated. I think they can, like I said, partner with tech companies in order, like Mountain, with like Trade Desk and others, continue to play a role there. But I think that clients are going to expect more strategy, more creative. That's what they really want to buy, because the media buying, the actual buying of the ads, is getting more and more automated. So they're in a transformation. I think a few, some of them will survive, and the ones that do well at that will become the consolidators. And obviously, Omnicom wants to be at the top of that pyramid. They want to be the consolidator.
So what does successful advertising look like these days, Mark? I mean, I know what the goal is, but I mean, how do you get there? Is it materially different than, 20, 30 years ago?
Yeah, it's changing rapidly. So one, we talked about performance, so direct response with Google, with Meta, with Amazon, with Mountain, that's the biggest segment of the market. But even within all these holding companies, traditional television and things like that, they are becoming in their own way more performance-based. So it used to be you would buy a show, you'd say, I want to be on the show, increasingly say, this is the audience I want to reach, what shows, they don't care what show they're watching, and that's over streaming, which is much more digitally enabled. So that is transforming incredibly fast. I think that 2025 is, if not already, more money going to be spent on streaming than spent on linear television. So this is a transformation for the agencies, for the networks, for everyone. And if you don't change, you are definitely going to be left behind. It's
a transformation for the workforce too. I look at Omnicom, and they have 75,900 employees. Interpublic has 57,400. You add that together, that's 133,000 people who work at these two firms. They're probably going to need to cut jobs. Can the advertising world, absorb this many people? What's going to happen to this talent?
Well, I think one, attrition will play its role. So actually, to broaden it a little bit, creative will grow. I mean, I know everyone thinks generative AI is going to replace creators. What it's going to replace is big parts of the creative production process, and make the ideation, coming up with the ideas faster. But good, strong creators, and you need a lot of them, are still going to play a big role. And in fact, I think that's going to expand. But the people that are in a supporting role, just on the media buy, they're going to kind of start to shrink because of attrition. And the last media buyer may have already been hired in this world. But it's not to threaten them, it's just to adapt. Technology does that, and I think ultimately the industry will be healthy because of it.
All right, Mark, great stuff as always, great analysis. Mark Douglas there, he's the CEO and president, of course, of the ad tech platform Mountain. A conversation about this interesting deal between Omnicom and Interpublic Group, basically valuing it about $13 billion. You put it all together, basically a $30+ billion deal. Yeah,
it's pretty massive, and it definitely feels like they're doing this from a defensive position. If they remade Mad Men, what would it look like in 2024?
A lot less harassment. How about that?
Yeah, a lot less harassment, and everyone, creative force going wild, but media buyers, they're done with that, as he was just telling us.
All right, well, one of several big deals we're going to be keeping an eye on the day and on the week. When we come back, we're going to keep our eyes on one of the biggest rallies of an individual stock, the Real, having a real rally up more than 40%. There's a retail marketplace getting the bullish call over at Wells Fargo. That's coming up next in our top calls right here on The Close on Bloomberg. All right, let's get right to our top calls. The big movers on the back of analyst recommendations. And we start off today with AMD. Advanced Micro Devices cut to neutral from buy over at Bank of America. The analyst flagging downside risk to the chip maker's 2025 expectations and lowers his profit estimates for the next 2 calendar years. He also cites greater competitive risk from other chip makers like NVIDIA, Marvell, and Broadcom. Those shares down about 5% on the day. Next up, let's take a look at Robinhood, an upgrade to overweight over at Barclays. The analyst saying retail trading on the platform showing no signs of slowing down, and he raises his price target on the stock to $49. He also says Robinhood, a direct beneficiary of the changing outlook for crypto as traders use the platform to trade the digital currency. Those shares, though, taking a leg lower, down by about 4% to their lowest levels in quite some time. And finally, Newell Brands, Truist upgrading the stock to buy and raising its price target to a street high of $17 a share. The analyst saying investors have overlooked the turnaround efforts made by the consumer products company, but now it's on the brink of seeing market share gains and revenue growth. Those shares having a phenomenal day, up a 12% to their highest levels since at least late April. We do want to stay, well, in the retail space, the consumer space, if you will, and take a look at one of the biggest movers of the day. Wells Fargo raising its recommendation on Real, an upgrade to overweight from equal weight, and a street high price of $15 a share. Ike Boruchow joining us right now, Managing Director and Senior Specialty Retail Analyst at Wells Fargo. Ike, is this all about growth or is this more about cost cutting?
Yeah, I mean, thanks for having me. Can I say both? What's interesting is this business came public, hyper growth, kind of, e-com bubble, but the growth was really, there was really nothing under the covers. The incremental margins were negative. The losses were getting worse, and the business model was questioned. If you look, you have to take a step back and look at the last 2 years. Multiple management members have changed over. Leadership has been, been looked at, but the cost structure and the model itself has changed dramatically. The revenue hasn't moved in 2 years, but the way they're generating revenue is. They're downsizing categories that don't make money. They're elevating the take rate where they need to so they can be profitable. And they're doing all these different things. Now the revenue is about to accelerate. Yeah. So basically the call here is that this business, which was really, not making money, very low margin, negative incremental margins, is now set to inflect revenue growth with incremental margins that are really, really positive.
What do their acquisition costs look right now when it comes to acquiring new merchandise? That was a big issue for investors over the last few quarters.
So they don't disclose CAC anymore, but I think what's important is when you think about the gross margins that they flow these revenues in at, how they've moved higher because they've elevated their take rate, i.e. they were losing money on sub-$100 goods before. Now they're not because they've elevated take rate in those categories. And so I think what matters now is that the gross margins are 2,000 basis points higher. Those are flowing through, and the cost structure is also being handled much more tightly. So that's why you're now about to be EBITDA positive. We think that they're going to be free cash flow positive next year. So all these things you can see are changing for the better.
So luxury brands have been losing a lot of customers, about 50 million customers over the past 2 years. Has the resale luxury market absorbed those customers and grown bigger by a proportional amount?
Not really. I mean, and again, that's the whole issue. A lot of these models, like Farfetch or Real, they've had a lot of issues they've had to work through over the past couple of years. What I think is interesting, just from a narrative perspective, is you think about, you mentioned the luxury brands. There's some pressure there. A lot of that's China, but pricing within luxury has gone, bananas a little bit over the past couple of years. And I think that luxury is becoming a category where consumers are more and more going to be shifting a look for value. So you really can't find more value than luxury resale when it comes to that category. And that's where Real has the #1 share.
Got it. Okay, so going forward, what's the one thing that the management needs to do to kind of continue executing and delivering the kinds of improvements like the take rate strategy, allowing lower value items to be profitable?
That's the beauty of the call. The hard work's been done. The lifting's been accomplished. Now we just need to grow the revenue line. And what we're saying is that since they've spent the last 2 years kind of working down that unproductive, inefficient revenue stream from the business, now you're going to start to see the market growth and the TAM take off, and this is going to get back to a double-digit revenue business. The difference between now and 2, 3, 4, 5 years ago is those incremental revenues are going to flow through at really high margins.
All right, Ike Boruchow, thank you so much. Ike Boruchow joining us from Wells Fargo. Coming up, we've got Chad Tredway, head of Real Estate Americas at JPMorgan, with his outlook on real estate in 2025. This is The Close on Bloomberg.
Just about 3:30 p.m. here in a drizzly New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu, and it feels like early December, like a lot of companies are trying to get a lot of stuff in before the end of the year.
Absolutely. I mean, we talk about all these M&A deals, at least 3 that have been announced, another one that's being speculated about with regards to Mondelez. And of course, you have some companies that are still dealing with activist investors trying to push for some deals, and that includes Macy's.
Yes.
Of course, everybody looks at Macy's as big retailer, but as we know, they have a huge real estate portfolio, and a lot of these activist investors want to unleash, I guess, the Kraken from that portfolio.
The activist investors see it as like a real estate company with, selling clothes kind of on the side.
I'm not sure the CEO sees it that way, but yeah.
Yeah, Barrington Capital and Thor Equities are urging Macy's to form a separate real estate unit, cut its capex, spin off Bloomingdale's and Bluemercury, and then start renting the property back from that separate unit.
It's not a bad idea, but it also gets to this idea of the quality of properties. Obviously, they have their big flagship here in New York City, which could probably fetch whatever the heck they want to charge
Herald
for it.
Square, yeah.
But there are a lot of other locations they own too that probably aren't going to have that same type of demand.
Well, you put it all together and maybe it'll unlock value. That's the thinking, at least. Let's talk a little bit more about real estate and the outlook for it. And we're pleased to welcome Chad Tredway. He is head of Real Estate Americas at JPMorgan Asset Management to kind of give us his outlook on how things are going to look in 2025. And Chad, you were just telling us how in the last 60 days, there's really been a sea change here in terms of how investors are thinking about real estate as part of their portfolio.
So we are seeing it in real time. It's been pretty amazing just to watch the markets. Things are happening incredibly quickly. A year ago, clients looked at real estate, it was out of favor. Fast forward to today, things are changing, and here's why. When you look at just relative value, the stock market has climbed by 50% in the last 2 years. But real estate, on the other hand, is down by 25%. So for the investors that we know, that we talk to on the ground, what they're saying is now may be the time to rotate out of equities because they've appreciated so much, and now's the time to go into real estate.
So when they go into real estate, what are they looking at and what are their priorities in terms of what they want to get out of that asset?
So it's interesting. The 2 things that come up more than anything else right now are cash flow and appreciation. So if you look at where we're investing, it's been across 3 themes because of this. The first one's housing. So we all know that housing in the United States has been challenged. It's incredibly difficult to find enough housing units for the demand. But what most people don't know is that the average age of a first-time home buyer is now 40 years old. So we've been focused on single family for rent. It provides appreciation, strong demand. We actually build the houses. So we're adding to the supply. We're not taking houses out of communities. Secondly is logistics. Clients focused on driving cash flow and appreciation totally understand this, and we see it all in our own life, by the way. So we're used to ordering goods on our phone, on the computer, and we want it there same day. Before COVID, you would order goods, and they would come to your house in 4 days. Today, it's a day and a half, and what's exciting about that is we buy all the real estate associated with logistics, truck terminals, industrial outdoor storage, infill properties, all which help you get assets to your doorstep much faster.
I am curious as to what type of competition you see for those assets, though, because a lot of people are thinking like you, too. They look at the housing market, they see opportunity in residential real estate. They look at all the stuff we buy online, they see opportunity in logistics. There are a lot of people going after the same assets.
That's exactly right. So where we really focus our fragmentation. So we look for inefficiencies in the market. We look for industrial outdoor storage where it's more fragmented, there's more owner users, more family users, and we have a data advantage being JPMorgan. We also look for trends that are coming. So our investors rely on us to understand what's going to happen. And so things like logistics and things like e-commerce are something that we see day to day.
So how hard is it, though, for you and your team to sort of find the right opportunities? Because we talk about investing, let's just take stock investing. To a large extent, a lot of it is kind of top down. You kind of start from the top, work your way down. That's not to dismiss the bottom up investors. Real estate is almost always bottom up. I mean, you have to have a view of what's going on the ground at a local level, right, to make a good decision, I would assume?
It's both, tops down and bottoms up.
Okay.
So we follow the consumer We follow business. We understand key trends. But the other thing is we've got 6 years of track record. So we are in the markets. The hustle factor is real. We're in the markets talking to people every single day. And what's nice is we own over 65,000 units across the country just with apartment. We own thousands of acres of industrial outdoor storage, and so we have a built-in information advantage.
Is there a geographic focus to that, or are you just kind of spread out around the country?
So look at migration trends. You look at the top 10 places that people are moving from California, from New York, from high-income states, it tends to be into the Sun Belt. So we have focused a lot of our efforts for acquisitions and our funds in the Sun Belt.
Is that getting too crowded? There are too many players in there?
A lot of people believe that the Sun Belt is too crowded. There's been too much building. And yes, we did see a slowdown earlier in the year, but guess what? There has not been a lot of new construction. So what we're seeing now is 2025 and 2026, we're seeing demand actually accelerate, and we see rent growth on the horizon.
So one thing that you've noticed is that the benchmark for institutional quality core real estate, there's an index that tracks that, has posted its first positive rent in over 2 years. What is your confidence that this is actually the beginning of an upturn, a sustainable upturn, as opposed to, a pause and, a steady downdraft?
So if you look at the data, which has been fascinating, the core Odyssey index was negative for 2 straight years, and it turned in Q3 of this year. Huge buy signal for a number of investors. So we saw investors start to leg in Q3 as this turns, and typically you get a 10-plus year investment cycle or appreciation cycle once the Odyssey turns.
That's interesting. So when we talk about people coming in here for opportunities, and they're not necessarily saying we want to beat the stock market, so to speak, right? But the idea is that the amount of returns that you get, at least maybe relative to other alternative assets, you think that's going to be better in the real estate space?
Well, we have to remember, real estate's not correlated to stocks or bonds.
It's not supposed to be.
It's not supposed to be.
Okay,
And it's going to offer diversification. It should offer inflation protection. It should be a good bellwether for your portfolio, which is exciting for us. So our investors look at it and they say, okay, if we can get the appreciation, if we can get cash flow that grows, if we're investing in high growth real estate, we feel pretty good about the prospects of it.
You've talked a lot about residential, logistics, a few other things that I'm forgetting. You haven't talked a whole lot about office space. And I'm talking about real office space here. A year and a half ago, it was all gloom and doom. We were just waiting for this wave of bankruptcies, this wave of defaults. That never really occurred. We had a few here and there, but they were more strategic defaults rather than just companies going belly up. What's happening there?
So the stat I love the most here is 80% of CEOs want their employees back in the office. 6 months ago, it was 35%. Wow. So I do think you're going to see office recover. We're seeing gains in office. Obviously, JPMorgan is a big office user. We have our new headquarters going up on Park Avenue. The winners in office are technology enabled, have great amenities, and both clients and employees actually want to go to the space. But we've all been to the office space that nobody wants. We've all been there. And so what we find is 60% of overall market vacancies are in 10% of office assets.
Oh, wow.
So there's real winners and losers.
All right, Chad, this was a fascinating conversation, and you're running a fascinating business over there at JPMorgan. Really appreciate you coming by. Chad Tredway there, did I just say JPMorgan? Asset Management, right?
Yes.
Head of Real Estate Americas over at JPMorgan Asset Management. We thank Chad Tredway for that. And just a reminder, we do get some earnings in the residential side later tonight. Toll Brothers earnings scheduled to drop after the bell later tonight. All right, when we come back, we're going to focus on our stock of the hour, looking at shares of Comcast, taking a leg down here after the CEO projected subscriber losses of more than 100,000 in the fourth quarter. That's coming up next, right here on The Close on Bloomberg. Welcome back. It's time now for our stock of the hour. Looking at shares of Comcast, down more than 8% after the company's CEO projected that broadband subscriber losses could top $100,000 for the fourth quarter. This primarily because of Hurricanes Helene and Milton, which caused around 10,000 of those losses. CEO Dave Watson saying competition in the residential broadband area remains intense. Isabel Lee joining us right now. The best of our team at Bloomberg that covers markets for us. And you have to kind of explain this for me because a lot came out of the CEO's mouth, some good, some bad, but the reaction in the stock market, certainly negative.
It really was a mixed bag, but I think it was more the outlook that scared people. 100,000 of projected loss, 10,000 of which is because of the hurricanes, which is an external factor. So there's still 90,000. And we know that cable broadband has really been going through a slump as of late. We have executives blaming a lot of things. First is the slowdown in buying of homes. And they said people who even buy homes, fewer sign up for cables. And of course, we have the increased competition with Verizon and T-Mobile, and of course, the likes of Netflix. Well, so it's really a mix.
Well, that's the one thing I'm curious. Is the fear that these losses are permanent? That once if these people if they don't have their broadband, they're never getting it back. They're never going to just say re-up.
You know, it could be because we saw third quarter earnings for the company beat estimates, but he also said that that's because of seasonality, because we know that return to school often means improved broadband numbers. So there is that. And I mean, just if you ask your friends, those who gave up their cable subscription, what are the chances of them getting it back?
Yeah, it's pretty unlikely at this point. So what did he say? What did the CEO say in terms of things that might encourage investors, that allay some of their concerns about these broadband losses?
There is this Warner Brothers reaching an early renewal of an agreement to provide networks like TNT and CNN to Comcast. And Comcast has around 12 million customers. So this is good because it avoids that channel blackouts that sometimes come with fee negotiations. And, you know, the terms of multi-year deals still aren't disclosed, but at least there's that. And in general, fee negotiations have been contentious. So this is kind of a smooth path for them so far.
Yeah. In addition, Warner Brothers is going to provide the ad-supported version of the Max streaming service to a bunch of its customers, Comcast customers. And that's kind of what it all comes down to, making these different deals to hang on to the people who are still subscribing to Comcast services.
Yes. It's one thing to get new subscriptions, but it's also another to make them sticky. Like, because everyone is just at the verge of giving it up. Like, even when you talk about just like Netflix and HBO, which do you subscribe to? It's honestly the array of choices is so confusing for consumers these days that I think it's really getting harder for companies. And of course, there's inflation, higher prices.
You don't have cable, do you?
No.
No, you just have all the streaming services.
Do you?
No. I got rid of cable.
I have skinny cable. I have a skinny
and then
bundle.
we did the streaming, which is like I said, it's basically a cable bundle at this point. Right?
Yeah, it is.
Given all the streaming services and everything else out there. Interesting to see, though, Comcast, maybe a little bit overreaction. The share is down 9%. Isabel Lee, one of our reporters, covers everything stock market for us here at Bloomberg. I was a little surprised by the market reaction to this. I mean, I understand.
It's a little aggressive.
Okay, $100,000, maybe you don't get those folks back, but I mean, the company is working on other things last time I checked.
Yeah, they have a theme park, for instance. But yeah, I mean, the thing with this part of the business is that it's been such a big moneymaker, right? And it generates huge cash flow.
Yeah.
And it's just another reminder of how it is in structural demise.
Yeah.
It's coming down. It's not going to come back. And yes, it might be 10,000 related to the hurricane, but over time, this is just going to continue to deteriorate.
Yeah, absolutely.
All right, coming up, we're going to take you to the close with Callie Cox, Chief Market Strategist with Ritholtz Wealth Management, as we take a look at an S&P 500 that has deepened its losses, now down 2/3%. I'm looking at it, and this looks like it's the biggest loss for the S&P in about 3 weeks, Romain.
Yeah, absolutely. No 58th record high for the day
Not
here
today.
As we count you down to the close, right here on Bloomberg.
We're constructively bullish, and the reason why I would say constructively and now outright is like our highest conviction view is volatility. We expect to see volatility, and typically when you expect volatility, you don't want to be long carry assets, but we feel it's different this time.
The volatility trade might actually work to the advantage of some traders. Earl Davis, head of fixed income over at BMO, kicking us off to the close just 50 minutes ago. Romain Bostic here alongside Scarlett Fu. 57 record highs for an S&P 500. Doesn't look like we're going to get 58 today with most of the names in that index in the red.
Yeah, with indexes actually falling to their session lows as well. The S&P losing about 0.6%. Both stocks and bonds under some pressure today. Even with a lot of M&A announcements, it's not doing much for sentiment, at least for the moment. We're also, of course, looking ahead to more earnings. Oracle will be reporting earnings. This is a stock that's gained about 80% so far this year, so a lot's been baked in.
Yeah, and that's the big question here. When you look at valuations, you look at the run-up in some of these stocks, the big question is what keeps it going? Is it just a good earnings report, or do you really need just a killer earnings forecast.
Yeah, or something more substantive when it comes to AI. We also have a look at the housing market with Toll Brothers reporting after the close.
Absolutely. Let's get right to it here. Callie Cox, Chief Market Strategist over at Ritholtz Wealth Management, joins us here in Studio 2 to help count us down to the closing bells. Just about 8.5 minutes to go. And Callie, I am curious about, everyone's putting out these year-end targets for 2025. Most are pretty aggressively bullish. There is a case to be made that corporate fundamentals will support some of those targets. When you look at corporate fundamentals, you overlay that with economic conditions. Do you see more of a case for this rally to continue?
I hope so, Romain. But when you mention that everybody's bullish, it does make you wonder a little bit if expectations are too high. And I would say that that's the biggest risk heading into next year. Yes, the corporate landscape looks solid. Profits are expected to grow in every single sector. That's obviously what you want to see in a strong market. But the problem is we're setting that bar a little high. And if, fundamentals and economic data doesn't reach that bar, then you could see a nasty surprise to the downside.
When you look at the run-up, particularly in the second part of the year, obviously a lot of that tied to the election and eventually Trump's victory in November, there's a question as to whether we've kind of pulled forward a lot of gains. Everyone's anticipating all these things that haven't happened. I guess when they do happen, is it going to be like a sell the news type of event?
Well, we're seeing the broadening already. And my mind goes back to corporate profits because markets follow the economy and earnings over time. So we've seen a broadening in profits over the past 2 quarters or so. Analysts expect that to continue. So I think we have pulled that trade forward a little bit, but there's so much value in the market outside of tech. I mean, everybody talks about the high price to earnings ratio. I mean, that's big tech in the tech and comm services sectors right there. So I do also think that we're in a strange bull market where you haven't seen a lot of stocks keep up with the major index. So we could see a little bit more of that rotation. And that's kind of what we're prepping clients for, too. Prices could go higher, but your portfolio could look a little different.
So when you say there's a lot of value outside of big tech, what are we talking about exactly? Are we talking about the energy and the materials sectors? Are we talking about healthcare? Where do you want to be looking for that value?
Well, rates are moving down. It's hard to say right now because there are a lot of crosswinds that you have to focus on. Of course, a lot of talk around policy. But when I think about the job market, it's clearly slowing. That's what we saw in the jobs report on Friday. The Fed has incentive to keep gradually cutting rates, and we see rates on the long end, potentially coming down too. So if you believe rates are coming lower, I still think there's value in rate-sensitive sectors, the banks and real estates of the world. If the economy holds up, then I think cyclicals could look a little more interesting as long as you're selective. But materials and energy, I'd just be a little careful there. It's hard. There's a lot of economic uncertainty.
Yeah, I bring that up because they're among the worst performers so far this year, and it sounds like they're not going to get much of a lift going forward either. So how do you think about which areas within financials and real estate to go into? Because they've already gotten a big lift off the Trump trade. This idea that a pro-growth agenda by the new administration will spur a lot of M&A, certainly within that sector as well.
Yeah, well, you have to remember, and I know you guys know this, but markets don't just move straight up, right?
No.
No way.
Recently it has, but
recently it has, but you have to think about balance, especially if you're a long-term investor looking over years and decades. And yeah, the trade has been all about pro-America, pro-growth recently, and that trade might be overdone. But hey, if some of this policy comes to fruition, especially on the deregulation side, I mean, that could unlock, small banks, for example.
Right.
And small caps, I mean, one of those areas of the market that are unloved. So, I mean, you have to think about, of course, your time frames. Over the next few weeks, maybe that trade cools off a little bit. But over the following year or so, if some policy does come to fruition, then certain sectors could look interesting based on the policy.
I'm curious, so for those longer term investors, not just the tactical traders, trying to make a buck over the next, 6 to 12 months here, when you look at the gains that we've seen in the equity market, and let's just assume a lot of people are sitting on some pretty healthy profits, do you think that they should, I guess, kind of take some of those chips off the table, or at least move them out of equities and maybe put them into something that kind of locks in those gains, whether it's alternative assets or fixed income or something like that?
Well, at Ritholtz, we believe value is the great equalizer in markets. So I'm going to tell you, based off of our philosophy, that yes, look for value within markets. If you do look for value, markets generally recognize value over the long term. So you're shielded on the downside and you have a little bit more stability on the upside. And I do think there is a lot of value in these markets just because we have had such a lopsided bull market. I don't know if it's quite time to lock in gains at the moment. I mean, I wouldn't be shocked if we saw a 5 to 10% pullback right here. Of course, you said everybody's bullish. That's usually the red flag there that says that, prices could cool off if we're surprised by some bad news. But I think it's time to maybe, prepare for a bigger slide because yields are so high, because those trades look relatively cheap.
I mean, maybe you can't answer the question, but I am curious about the psychology of why you're not seeing more downside protection. We started off the show with kind of a look at the CFTC data. Asset managers, the biggest net longs, basically, since at least the pandemic, similar for some of the speculative traders as well. And then when you look at for where the hedging is, whether it's through the VIX or through options or other things here, it's hard to find.
Yeah, momentum is a powerful drug. That's all I have to say. If you've been hedging recently, you've gotten burned. And of course, hedging looks a little bit differently in my world. We're generally thinking about fixed income as the all-weather portfolio and, having bonds to protect you against anything that comes your way. But even I am surprised by how high and consistently high the 10-year yield has been. And that's why we're telling clients, right now is the time to prepare for that big slide, just because, bonds, for example, do look so cheap.
Yeah, absolutely. And particularly for folks of a certain generation that kind of only have really had an opportunity to buy bonds when those yields were at very low percentages, 4.5%. Not bad, Callie.
Yeah, not bad.
Callie Cox, Chief Market Strategist over at Ritholtz Wealth Management, helping us count you down to the close. Just a little less than 3 minutes away, and stocks pretty much holding where they've been for most of the show, Scarlett, down 0.7% on the S&P 500.
It does make you wonder to what extent or at what point these international headlines that keep cropping up over the last 2 weeks is like something that will cause people to just go risk off overall. It hasn't happened so far.
It hasn't happened, but you saw what happened over the weekend, obviously in Syria. Obviously all these unresolved issues in the Middle East and of course in Ukraine as well. So at some point, this will have to be reckoned with by markets.
Absolutely.
We continue to count you down to these closing bells. A full breakdown of all of today's market action. That coverage starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through that closing bell, a global simulcast. It starts right now. Tim Stenovic in the radio booth, joined today by Katie Greifeld, filling in for Carol Masser. Alex Steele has the day off as we welcome our audiences across all of our Bloomberg platforms to parse the most crucial moments of the first trading day here of the week. A trading day, Tim, where we're seeing stocks in the red.
Yeah, NVIDIA certainly weighing on the trade, but I was just talking to Katie about Taylor Swift because the Eras Tour wrapped up and Katie got to see Taylor Swift.
Not in Vancouver, did she?
No. In Toronto, though.
Yeah.
It was like one of the final shows.
Yeah, it was pretty amazing. And I'm sad to see it go, the Eras Tour. You think about, again, the economic impact. Maybe that's why the stock market is down today.
It all comes back to markets.
Yeah, I could imagine some bears making an appearance now that Taylor Swift's Eras Tour is over.
Who's going to stimulate the U.S. economy, the regional parts of the U.S. economy, and be included in the Beige Book now that the Taylor Swift tour is over?
I shudder to think, someone has to pick up the mantle.
Well, we talk about sort of the $2 billion plus or whatever that she's grossed on that tour. I guess the big question is, what does she do with that money? You think she's piling into stocks? Is there some like ETF that Katie knows about, or maybe Bitcoin?
S&P 500. No, I think she's an index investor, Taylor Swift.
Yeah, she strikes me as that here. But look, the idea is that you're sitting on double-digit gains in the equity market. You're sitting on pretty healthy gains, even if you're in fixed income. And then, of course, I don't know, Bitcoin. Tim Stenovic.
Yeah, losing a little bit of momentum today, but still, hovering around above 95,000.
All right, well, I hope she invested wisely so we don't have to go through another Eras Tour all in 2025 as the Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite all close out the day in the red. The closing bells here in New York as we wait for these numbers to settle. The Dow Jones Industrial Average is going to move lower by more than 200 points or about 0.5%. The S&P down by more than 30 points or 0.6%. The NASDAQ down by a similar percentage drop, and the Russell 2000 shedding roughly 16 points or 0.7%.
The S&P 500, if you pull back the layers of it, it's still getting settled, but we got 230 stocks moving higher today, 272 stocks to the downside.
All right, let's take a look at the sector performances, too, and pull up the IMAP. And there's a lot of red there. The only two sectors that finished in the green are healthcare, up by 0.25%, and real estate investment trusts gaining about 0.1%. The big decliners, financials losing 1.4%, communication services and utilities each down at least 1.3% as well.
All right, let's take a look at some of the gainers on the day today. A lot of news when it comes to M&A, potential M&A driving stocks higher. Look at that. Shares of Hershey up close to 11% today. It's the most going all the way back to 2016. At one point today, it was the highest in more than 2 decades, going all the way back to 2002, or the most, I should say, going all the way back to 2002. It is the highest going back to September of this year. Shares of the Hershey Company surging after Bloomberg reported that the snacks and sweets company Mondelez International is exploring an acquisition of the company. Our Bloomberg News team reported that Mondelez has made a preliminary approach about a possible combination, said that people who asked not to be identified, but because the discussions are private. We talked to Crystal C a little earlier. She's Bloomberg News Deals reporter. We don't know a lot about the numbers here, but the idea, of course, has to do with scale, declining business when it comes to snacking, fears of Ozempic, rising cocoa prices. This has been attempted before, back in 2016, I believe, so we'll see if it ends up happening now in 2024. Also, shares of Interpublic Group, speaking of the world of M&A, the advertising and marketing company Interpublic Group surging after news that Omnicom would acquire the company, creating the world's largest advertising company. Shares higher today by about 3.6%. The deal values Interpublic at $13.3 billion, excluding debt. It'll create a company with a combined annual revenue of over $25.6 billion. And shares of Workday also rising today. This as it's set to join the S&P 500, shares higher by 5%. We learned this after the close on Friday. Inclusion, though, in the benchmark, it's becoming more important for companies in a world that's increasingly dominated by passive investment funds. Maybe Taylor Swift is an index investor. On the flip side, expulsion from a benchmark can weigh on stock prices as passive investors are forced to sell the shares that realign with the S&P 500's new composition. Shares of Workday higher by about 5% today, Katie.
To be clear, it's not disparaging to say Taylor Swift is an index investor because the S&P 500 is up 28%
it's
and
like the smartest move you could have made over the last decade, right?
Exactly. Well,
but does she follow SPY or the Qs?
It's a good question. Probably SPY, but again, I don't know this woman. In any case, let's take a look at some of the decliners today. We start with NVIDIA weighing on the big benchmarks. NVIDIA shares down 2.6%. That's after news that China has opened an investigation into NVIDIA over suspected anti-monopoly law violations related to that 2020 acquisition of Mellanox Technologies. And then Tim was just talking about this, of course, Omnicom to buy Interpublic in a deal that would create the biggest ad company. We don't have a price tag yet. The final price will be based on Omnicom's share price at the time of the deal's closing. That's expected to occur in the second half of 2025. But investors anticipating here that maybe it'll be a big one. Shares down double digits. And then I did want to end with T-Mobile. This was interesting. We heard from the CEO saying to be cautious about fourth quarter results. Basically, investors hearing that and selling, even though the CEO also said that results will be back-end loaded due to year-end factors. Shares finishing down about 6% or so.
Yeah, interesting comments from the T-Mobile CEO. And a quick honorable mention, shares of Kimberly-Clark down about 1% on the day. This after we learned a little bit earlier during the start of the show that Costco is switching manufacturers for its Kirkland brand diapers, which had been made by Kimberly-Clark.
Costco moves markets.
Now that's being replaced by First Quality to do that. Let's take a quick look at yields here. Basically, seeing modest gains across the board for yields, up about 2% on your 2-year yield, the most rate-sensitive portion of the yield curve, just about a week or so away from that next big Fed decision. Your 10-year still camped out right around 4.2%.
We are waiting several companies to report earnings. We're waiting on Oracle, set to hit just in the coming minutes. Vail Resorts, also MongoDB, C3AI, Toll Brothers coming a little later for a look at least one part of the housing market. In the meantime, I do want to talk a little bit about the way that NVIDIA has been weighing on markets today. We do know that China has opened a probe into NVIDIA. The idea is that there's suspicions that the U.S. chipmaker broke these anti-monopoly laws around a 2020 deal. It takes aim at the company as Washington steps up sanctions. Also raises questions what happens, Scarlett, when a new administration comes in January.
All right, let's break down some earnings. We just got results from C3AI. This company reporting a loss for the quarter, adjusted loss per share of 6 cents. Analysts were looking for a loss of 16 cents, so this is narrower than what was anticipated. It also raised its guidance for the full year as well, for the full year 2025. So you look at the stock price right now, the knee-jerk reaction is a big, big bump up of about 10% in after-hours trading.
Oracle's fiscal second quarter results are out. Cloud infrastructure revenue in line with estimates, $2.4 billion. The street was was looking for, well, $2.4 billion. The share has taken a little bit of a leg lower here, despite the fact that adjusted revenue overall was up in the quarter, up about 9% to $14 billion, though that was just a touch shy of the average of street estimates. You see it there, 14.06. The street was looking for 14.12 in the most recent quarter. Operating margin relatively in line at 43 cents. And your bottom line number, 2Q adjusted EPS, $1.47. The street was looking for $1.48. So it looks like either in line or modest misses on most of the key metrics for its fiscal second quarter. Still coming through the release now to look at the outlook.
Okay, you guys are watching C3 AI and Oracle. Oracle down by 6%. I'm looking at shares of Vail Resorts higher right now in the after hours by close to 5%. Shares down 10% so far this year. The company sees fiscal year total reported EBITDA $844 million to $906 million. First quarter total skier visits coming in shy of estimates at 548,000 versus estimates of 610,538. The company does see fiscal year net 240 million to 316 million. Saw 224 to 300 million, and that's probably one of the reasons why the stock is higher. First quarter net revenue coming in at 260.3 million. That beats estimates of 252.9 million. First quarter loss per share coming in below estimates at $4.61. Estimates were for $5.03. Shares now higher by about 3.3%.
All right, let's also check in on MongoDB. It develops software, database software. You can see it beat on a number of measures. The third quarter revenue beat estimates pretty handily, $529 million. The expectations had been for a share lower than $500 million. And some movement, too, in the C-suite. COO and CFO Michael Gordon two-step down here. You add it all together, see how the shares are reacting up mightily right now, almost 10% after hours. But guys, heading into this print, MongoDB shares down by more than 14% year to date.
All right, so we are still getting earnings. We'll get Broadcom a little later this week, Costco as well, Adobe coming on Wednesday. Before we get those numbers, though, we will see you guys back here, same time, same place tomorrow. That is going to do it for our cross-platform coverage of the closing bell on radio, TV, YouTube, and Bloomberg Originals. We'll see you tomorrow, guys.
And we continue our coverage here on Bloomberg Television. A close eye on the after-hours trade. C3 AI, MongoDB, and Vail. Those are your big gainers. One of the biggest decliners, though, is Oracle. A full breakdown of all the earnings coming up after the break. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A little bit of a tepid start to the week, coming off what had been last week a record run for U.S. stocks. Here on this Monday afternoon, the NASDAQ 100 down about 0.8%. You saw similar declines for the S&P, the Dow, as well as the Russell 2000, despite the fact that you started off the day, at least over in Asia, with a pretty powerful rally, but that did not seep through, neither to Europe nor to the U.S. Your two-year yield camped out where it's been for quite some time. That could change in a big way as we head into next week with the Fed meeting, and Bitcoin still straddling in the line of 100 grand.
So a little bit risk off today, which is surprising given there was a lot of M&A headlines. It was an M&A Monday, to be sure. You had Mondelez, according to Bloomberg reporting, approaching Hershey's with a potential deal. By the way, this is not the first time the two have kind of hooked up, because back in 2016, Hershey rejected a $23 billion bid to merge, and Mondelez ended up walking away. Nevertheless, Hershey shares up about 11% on the day. We're also looking at Comcast as the worst performer in the S&P 500, losing almost 10% on the day. The CEO, Dave Watson, telling investors that the company expects to lose more than 100,000 broadband subscribers because of intense competition, 10,000 of which is tied to hurricanes. But nonetheless, that was a big round number that did give investors a bit of a scare. Romaine?
All right, we are keeping an eye on shares of Oracle. That is your biggest decliner in after hours, at least among the large cap stocks. The software company out with its most recent earnings report. The numbers, well, not necessarily out of line. $14.6 billion in adjusted revenue, relatively in line with estimates, up about 9% year over year, and adjusted EPS at $1.47. The street was looking for $1.48. And of course, that cloud revenue that everyone pays attention to, also just a smidge below what the street was looking for at $6 billion. Anurag Rana joining us right now, who covers technology for us over at Bloomberg Intelligence. And this seems like one of those earnings reports where we're really splitting hairs here. No real big beats here, but no real misses. investors pushing the stock down. Why?
Yeah, I think it's just that perhaps the investors were looking for a very big beat. That didn't happen. I think they did well on the revenue side. 9% growth in constant currency is pretty good in this environment, frankly. And infrastructure as a service grew 52%. So, from our sides, the number looked good, but it seems from the reaction that investors were looking for a bigger beat.
Not good enough seems to be a common theme for any stock that has been pushed up quite a bit. And Oracle's been pushed up about 80% so far this year. What does the company need to say on the conference call to get people excited and thinking that the gains justify what it has in store?
Yeah. So if you look at cloud infrastructure as a service, it grew over 50% right now. Consensus for next quarter is roughly around, I think, 56% or so. And that number will dictate which direction stock goes later today. And they'll give the guidance on the conference call. If the number is around that area, as I said, 55, 56, that's going to be very good. But if it falls in that, 50 or below, that's not going to be good. I mean, frankly, everything hinges on that particular guidance.
I am curious, so when we talk about the cloud infrastructure play and the gains that they've made in that space, Anurag, I mean, where do you kind of rank Oracle right now within sort of the realm of these providers? I mean, are they basically near the top of the list?
No, they are fourth on that list. The Amazon Web Services being the biggest, followed by Microsoft, then Google, and then Oracle. What's happening right now is because of AI and cost optimization across localized data center, people are moving more work to the public cloud services. And so there's excess demand right now, which is giving them Oracle a real new life, I would say, because remember, a few years ago, this company was growing at 4-5%. Now it's growing at somewhere in the 8-9%. It could go into double digits next year. So I think all of that is driven by their cloud infrastructure business. But what we see is that all of the boats are going up, not just Oracle.
You make a good point about the growth rate and how much it's changed from a couple of years ago. And they're doing this without necessarily a lot of acquisitions as well. Has Oracle broken its habit of having to serially acquire other companies to maintain and boost its growth?
Well, they did buy Cerner a few years ago, but the growth that I'm talking about right now, 9%, I mean, almost all of it is organic in nature, which is pretty good for a company this size that's pretty old in nature as well, with their old database products, old applications. But if you look at it, cloud infrastructure business grew 52%. I mean, that's like any other startup would be very proud of those numbers, frankly.
Anurag, really appreciate your joining us. Anurag Rana of Bloomberg Intelligence giving us the latest there on Oracle, whose shares are down about 9% in after-hours trading, given the high expectations investors had coming into those results. Let's stick with technology because we're also keeping an eye on shares of C3 AI. That stock is higher by about 15%. And MongoDB, which is making a change with some executive shuffles there, up about 11%. Joining us now to discuss is Sarah Kunst. She is Managing Director at Cleo Capital. So, Sarah, walk us through a couple of those companies we just mentioned. C3 AI gets a lot of attention, I suspect, mainly because of its ticker AI.
Absolutely. Sometimes marketing really pays off. C3 AI is a perfectly good, relatively small enterprise AI company, right? It's sort of it is sitting there doing some interesting things. It's, partnering with some bigger companies to help small startups kind of figure out what they want to be doing in AI. It works. That being said, the insane amount of attention that is almost directly correlated with if AI is being talked about a lot, if markets are frothy, then AI, the ticker goes up, indicates that a lot of that kind of quote unquote value is less about the company and more about probably the best marketing coup in the history of tech.
Okay, got it. All right, so that's the story for C3 AI. When it comes to Oracle, I know we just talked about this with Anurag, how much is AI really a true part of the story as opposed to this is a legacy tech company. It's got some play in the cloud and in AI, and we're going to extend a lot of optimism towards it because of its legacy.
So I actually don't think that these legacy tech companies get a lot of optimism. I love a legacy tech company kind of making good in these spaces. I think that they are very hard to beat when it comes to things like cloud and AI. And we've seen that with, Microsoft, with NVIDIA, with Taiwan Semiconductor. There are a lot of these companies that have been around for a really long time. They have IP. They have deep pools of talent and ability to buy companies. And I think that if they decide to play to win in these spaces, they will. The person who actually used to head up Oracle's cloud business actually went over to Google in 2018 and has done some really great stuff there. So they understand they have the capability to do it. They just need the right people at the helm. And in the last couple of years, I think that, companies have started to take them seriously. And most giant enterprises are already using Oracle. So if they can say, hey, look, we're going to make it cheap for you to use our cloud, we're going to make it cheap for you to use sort of some of our AI resources, I think that it's going to be a very sticky product that's hard to beat.
We've certainly seen that, and we've even seen some CEOs, not necessarily Oracle, kind of articulate that stickiness and the idea of why folks would stick with them. I am curious, though, Sarah. I mean, it's interesting to see some of these older tech companies, if you will, sort of find their space in this new technology. I'm curious about some of the younger companies, the ones that have sort of entered this space and to a certain extent even defined that space. Do they become the next Oracles, the next Microsofts, the next Googles of the world?
I mean, we're 20, 30 years away from knowing if that's what OpenAI is going to do. But it's worth saying that something like an OpenAI is still in a lot of ways kind of under the control of Microsoft, right? So how do you become Microsoft when Microsoft has all that control over you? And so, certainly transformative technology can happen. I think when you're talking about companies that have maybe been a little bit better with marketing than they have with sort of the core innovation, that is probably less likely long-term to become these multi-trillion-dollar companies.
But how do you measure the valuation or what the true valuation? It's easy to do that with a mature company like a Microsoft or an Oracle because you have a lot to compare and you can sort of compare the traditional metrics. It's hard to do that for a startup, particularly one that's still private. It's hard to do that with companies that don't have a long track record of cash generation, revenue, or even profitability.
It absolutely is, and the joke in venture is that you want to keep valuing yourself higher and higher before you have revenue, because once you do, you're going to be tied to that revenue. And so the reality is that some of these startups can get away with wild valuations, pre-seed rounds in the hundreds of millions of dollars because of their resume. And at the end of the day, if they don't have IP yet, if what you did yesterday does not necessarily tell me that you're going to make me a billionaire tomorrow. And so we saw a lot of that in AI about a year and a half, 2 years ago. It's starting to cool off because a lot of those companies haven't worked out. A lot of those founders have sort of sold out early because the higher your valuation is early on, the harder it is to employ new people because they say, wait, I have to come on and do the crazy startup thing, but I'm only getting, my basis cost is in the hundreds of millions or billions of dollars. That's not as exciting to people.
All right, I agree. Sarah, always great to catch up with you and always appreciate you taking time to give us these insights on the fly. Sarah Kunst, Managing Director over at Cleo Capital. A closer look at big tech. Let's take a look at what's going on in the pharma space. Eli Lilly approving a $15 billion share buyback and boosting its dividend by roughly about 15%. Potential boost to a stock. Of course, it hit a record high all the way back in August, but hasn't really been anywhere close to it ever since. The shares getting a modest bid here in the after hours trade, up about 1%. And be sure to catch an interview, a sit down that we had with Eli Lilly's CEO. He sat down with David Rubenstein. That will air tomorrow at 12:30 p.m. New York time.
Perfect timing, given the news that we just got. All right, coming up, China is investigating NVIDIA over suspicions of breaking anti-monopoly law. We've got more on that developing story next. This is The Close on Bloomberg.
All right, let's take a look at shares of NVIDIA, down for a third straight day. In fact, a trifecta of losses that we haven't seen since at least mid-September. This following China's investigating the chip maker over suspicions it broke anti-monopoly laws around its 2020 acquisition of Mellanox. The probe coming as sanctions and tensions are escalating between the U.S. and China. Michael Shepard joins us right now, senior editor of technology and strategic industries here at Bloomberg News. And I guess I'm surprised, but not surprised, Michael. I mean, is this what we're going to live with now for the next 4 years? Basically, China coming after our companies as we go after theirs?
Well, we've seen a little bit of this tit for tat already in the past week. About a week ago, the Biden administration unveiled new restrictions on high bandwidth memory chips and the sales of advanced semiconductor manufacturing equipment to China escalating a series of export curbs that they have been rolling out over the past couple of years. And within a day or so, Beijing responded with curbs on critical minerals, including gallium and germanium, that are critical to the development of semiconductors and satellite parts that are used in military applications. So this is fitting into that pattern as well. And it is something that we could see continuing, especially as Donald Trump prepares to take office with a promise to get even tougher on China.
Right, absolutely. So in this case where China is targeting NVIDIA, is it because it's kind of the poster child for U.S. excellence when it comes to AI and chips? Or is there something specific with this acquisition of Mellanox that might look problematic or could yield something more interesting?
Well, it was interesting that they singled out the Mellanox acquisition back in 2020. NVIDIA bought it for $7 billion back then. And of course, it's a fraction of what the market losses were today for NVIDIA, which is the world's most valuable company. It's seen its shares before today climb more than 188%. Since the beginning of the year, really on the hopes that it would be driving this artificial intelligence revolution that so many companies have pointed to as the next generation, not only in technology for the tech industry, but for businesses as a whole. And yet, that preeminence in this area of AI for NVIDIA is also drawing a lot of attention, not only from Chinese antitrust regulators, but even here at home. The U.S. Justice Department has been scrutinizing some of its conduct. Yeah. And even in Europe, we've seen that as well.
But Mike, I mean, you've covered Washington for a long time. There was a great story in the Bloomberg terminal today that showed how Russia is getting its hands on chips that it's not supposed to have its hands on. I mean, how much are these controls and all these barriers that either U.S. puts up or China puts up, how much of that is really going to actually impact these companies if there still is a workaround for these chips to get sold?
Well, that's a great question, Romaine, and it really is about how effective these export controls are once they are put into practice. And for that matter, when you think about what China is trying to do in terms of this brushback pitch against NVIDIA, China doesn't want to let go of access to NVIDIA's technology completely. If it were to bar it from the market or impose heavy penalties, for NVIDIA, it's about 15% of its sales. But for China, there is the importance of having access to NVIDIA's latest and most groundbreaking chips. The Biden administration has restricted those most advanced chips from entering China, but even the older chips from NVIDIA to China have some value there, too.
Michael, really appreciate your joining us. Bloomberg's Michael Shepard is senior editor for technology and strategic industries, which means we'll be talking to him a lot over the next few years.
Yeah, strategic industries, right? He's a busy guy over the next 4 years here. All right, when we come back, we're going to take a look back in history at United Airlines and one of the longest bankruptcies ever. And here's a question before we go to break. United's bankruptcies in the 2000s, it dragged on for 3 years. However, it was not the lengthiest proceeding ever. That title belongs to which company? All right, it was on this day, December 9th, 2002, when UAL Corp, the parent of United Airlines, filed the largest aviation bankruptcy in U.S. history. Record losses, high costs, and a travel slump, leaving the world's second biggest carrier unable to pay about $1 billion in overdue debt. Now, while that bankruptcy was the result of a hodgepodge of events that had been bubbling up for years, the tipping point really came with the fall of 4 key dominoes over a 2-year period. A labor dispute that drove up compensation costs, a plan to merge with U.S. Airways that collapsed in mid-2001 amid government pushback, the September 11 tax that year that upended the economics of air travel, and the denial of an almost $2 billion government-backed loan that would have actually served as a lifeline for the company's struggling income statement and balance sheet. In fact, UAL filed for court protection only after it neared the end of that grace period on its overdue debt amid 9 straight quarterly losses. United Airlines, the biggest of the 28 UAL business units, included in the bankruptcy filing, listed $23 billion in assets and about $21 billion in debt. The business and financial structure, it was so complex, involving dozens of business units with dozens of third-party partnerships and thousands of creditors, that James Spragran, the Kirkland Ellis lawyer who led the bankruptcy team, he told the Chicago Sun-Times back in 2006 that the United case was the longest and most difficult bankruptcy ever. Now, officially, It took 1,150 days for United to exit bankruptcy, which at the time was actually already on its way to being eclipsed. And that brings us to our question of the day. While United was in bankruptcy protection for roughly 3 years, which company surpassed that record almost immediately, and by how much? The answer, chemical company W.R. Grace. It took 12 years for Grace to work through its bankruptcy proceeding after it filed for protection back in 2001, trying to escape more than 100,000 asbestos-related injury lawsuits. As for UAL and United Airlines, the bankruptcy actually was a bit of a blessing in disguise, setting up one of the more notable comeback stories of the modern era, a comeback that saw United emerge as a much leaner and more efficient airline that helped it reset a path to growth and profitability, and ultimately helped it weather the pandemic disruptions of 2020 better than most of its peers. Scarlett?
W.R. Grace. I had not thought about that as a possibility. I was thinking Radio Shack because it felt like it was in bankruptcy protection for a while, too. Or maybe people were looking for it to be in bankruptcy. In any case, let's move from that to Toll Brothers, which has just come out with its results. Toll Brothers' fourth quarter EPS and sales beating analyst estimates. Revenue of $3.33 billion, higher than the expected $3.17 billion. Earnings per share of $4.63, beats the consensus estimate by 30 cents. The backlog for the fourth quarter was 5,996. Higher than the anticipated 5,920. As for the current quarter outlook, it sees first quarter adjusted home sales gross margin of 26.3%. That does miss the average analyst estimate of 27.3%. And 2025 deliveries will be about 11,200 to 11,600. Analysts were looking for 11,414.
I'm interested to see if they can hold that gross margin here. A little bit of a slip in the quarter, and at least on the 2025 forecast, a fraction of a point lower here at 27.3%.
All right, we'll continue to keep an eye on that stock in after-hours trading. Let's move on from home builders to home decor, because Boll Branch is expanding on its mission to give customers cozy and sustainable bath and bedding products. But unlike other direct-to-consumer retailers, it operates on the philosophy of a hospitality business. Here with more on what sets it apart from the rest of the pack are Scott Tannen, its co-founder and CEO, and Missy Tannen, co-founder and chief design officer. Welcome, Tannens. Thank you for coming in today.
Thanks.
I want to start with you, Scott, about just what was the idea, what was the drive behind starting this company? Because you talk about a conflict-free supply chain. I'm not sure what that means. And if I don't understand what that means in 2024, I don't think I would have known what it meant in 2014.
Sure. I mean, look, like most people that start a business, we're consumers to start. And you know, we were out in the market trying to buy bedding for ourselves. We went from a queen bed to a king bed, which, as you know, in life is one of life's amazing changes, where everything that maybe your mother-in-law had bought you no longer fits. So here, you know, Missy was in market and came home kind of confounded by the choices at all the different price points. And I actually just thought I would jump on Google and solve this problem for us. And what I found was, you know, the reason it was really hard for us to find the bedding that worked for us was, you know, it just didn't exist in the marketplace. It was a lot of sameness at all different price points. And when we started peeling back the layer of the onion, I wasn't necessarily trying to start a bedding company at the time. I was just trying to learn and figure it out. And when you talk about supply chain, I mean, the textile industry supply chains don't have a great reputation. And as we did our research, we realized that was for good reason. So we set out.
But where did you get your supply from initially then?
So initially we started in India. And we started first by understanding the cotton supply. The reason most of the sheets in the marketplace were not at our standard were simply because the cotton they were starting with was low quality, even at really high price points, even at high-end luxury brands. So we started with the best cotton on earth. Our question was, where is that? What is that? And we found that there were smallholder farmers in parts of India where GMO seeds were outlawed, and they were growing cotton organically. The problem was there was no demand. So our dream was, well, what if we could actually create a business and somehow satisfy maybe some of that demand? Little did we know that 10 years later we'd be the largest consumer of fair trade organic cotton in the world.
Okay, so that's kind of the origin story. Missy, if you could jump in here as well and talk a little bit about the philosophy of treating this as a hospitality business rather than a retail business. What does that mean in practice?
Sure. So at Boll Branch, we care about everyone who touches our products, whether it was someone in our supply chain, all the way to our office, all the way to the customers. So when we think about hospitality first, we really want to make sure that everyone, you know, is appreciated. Everyone is taken care of in our retail stores. If you need, to outfit your new bed, we will gladly come to you, style your bed, provide services that no one else can provide. But really just going a step above and do whatever we can to make someone happy, to love their bedding. And really, we just want everyone to enjoy and appreciate.
Does that create more of a repeat business? Because this has always been the challenge in this kind of the sleep space, if you will, is that most of us buy a mattress once every decade, probably not as frequent as we should. The same thing with sheets. I mean, we probably don't buy them as frequently as we should, but you know that. So how do you make sure that you're generating revenue without necessarily having new acquisition costs?
Absolutely. Well, actually, it's an interesting statistic that in our industry, usually someone will purchase 2 times a year in bedding. And our average is now 5 and above items per customer. And so we're really proud of being able to make sure everyone, first of all, loves the products that they have, but then what else can we recommend? What goes with that? Your sleep space is such a private, personal space, so we really want to tailor our products to every unique customer.
I am curious, though, Scott, if you can talk about marketing as well. I mean, you walk in and you look for sheets, and it's just a mind-boggling array of brands and different styles. And I mean, how do you sort of separate yourself? I just went through this product. We just redid all our bath stuff, so like towels. And I know it was like excruciating. I mean, we eventually found what we liked. Yeah, I mean, for me, my wife enjoyed it. But eventually we found what we liked. Sure. But it was hard. It was hard to find out what really stood out, and more importantly, what we could trust.
Yeah, I mean, think about it. I mean, had you walked into a Boll Branch store, it wouldn't have been a problem. But we'll get you on next time. But the reality is, look, this is a category that everybody plays in. Yet, how many of us are educated as consumers? We're educated about our food. We're educated about other things. But how much do we know about the materials? Do you realize that how the twist tension of a towel is going to directly contribute to how well it absorbs, how well it holds water, right? So all of our products are designed by Missy and her team, in-house and engineered, which nobody in the category does. Everybody else is buying and importing. And what really sets us apart is we're a little bit like making a homemade chocolate chip cookie in a world full of Chips Ahoy, right? And so what makes our product stand out is we have to get people to buy once. And once they buy once, their entire home turns into Boll and Branch because, it becomes,
So you put the thoughtfulness into the product at the very beginning, and you count on people to recognize that. That makes a lot of sense. And certainly when prices are stable, it's something that people prioritize. How much do consumers prioritize that and fair trade and sustainability when inflation continues to kind of dominate their concerns?
Yeah, I mean, people buy quality. In tighter economic times, people don't stop buying luxury products. What we see is that this is, I think, true across the entire luxury industry, is people become more thoughtful about how they're deploying their dollars. And so that's where reputation becomes so important. That's why we focus on hospitality and service and those sorts of things, because we stand behind the products. We're not a faceless private label that you get at a department store. We're Scott and Missy, and we, if you would have called the 1-800 number this past week after Cyber Monday, there's a good chance I would have answered the call. And that's the level of closeness. And so Missy and her team could tell you a deep story about every single product we make, because we're not just ordering products. We're designing them, manufacturing them, and bringing them to the customers. And so they're substantially different, and you feel it right away.
I'm just curious, Missy, and you're definitely going for a more high net worth consumer, at least based on the quality, the price point, also where some of your locations are based, which tend to be in much more affluent areas.
I would say our retail stores are where we see a high, proportion of our customers already. So when we go, we actually surprisingly have customers all across the country. It's not just in those locations, because online which is where we do most of our business. You can look at a map at any day of where our people are shopping from, and it's really everywhere, not just the coast, it's all across the country. But certainly when we were starting our retail stores, we wanted to be in places where we already had cheerleaders in that town who already knew Boll and Branch and could share it with their friends and their family. And so that's where we went first, is where we had a lot of customers already.
All right. Well, a very great story. I guess still a family business and still growing. Scott and Missy Tannen, co-founders of Boll and Branch. Scarlett.
All right, let's give you a quick recap of how markets closed on the day. It was a down day for equities. I believe it was the worst day for the S&P 500 in about 3 weeks. And not just stocks falling, but also bonds falling. A lot of key inflation data coming out. CPI on Wednesday, PPI on Thursday. As you noted earlier, Romaine, the day started off with some optimism given the comments out of Beijing about stimulus, aggressive economic stimulus. So far, the most aggressive we've heard so far from Beijing.
The most aggressive we heard so far, and you saw that reflected in the shares, some of those ADRs of these Chinese companies here in the U.S. The question is, where's the spillover? It didn't spill over into Europe, and certainly didn't spill over here into the U.S. in the cash session. Meanwhile, in the after-hours trade, we are seeing some movement, mostly on the back of earnings. Oracle, one of your big decliners in the after-hours trade. I mean, this didn't really seem like that big of a miss to me. And we talked with Anurag earlier.
No, they basically met, but this is a stock that's gained about 81% so far this year, so that'll do it.
Yeah, absolutely. Take a look at C3AI, a big boost there after boosting its full-year revenue outlook. And MongoDB trying to get back into rhythm here, up 9% in the after-hours trade. This is the close on Bloomberg.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Steve Cohen, the New York Mets owner, breaking records by signing Juan Soto to a 15-year, $765 million contract. This makes it the most expensive Major League Baseball contract ever, surpassing Shohei Ohtani's 10-year, $700 million contract with the Dodgers.
Yeah, not just the most expensive contract, but this is now the most expensive roster heading into the new season ever. He better win.
Well, he's trying to buy a World Series with his first 5 years of owning the team.
We've seen other companies go down this road with these big spends, and we've seen how some of them have flamed out here. But of course, obviously, Soto, a huge asset, just going across town here to Queens. So I'm keeping an eye on Tony Spring. He's the CEO of Macy's, and that's because he's having to keep an eye on all these activist investors that are coming around kicking the tires. But kind of interesting here to see the new round of activist investors, which primarily involves two companies that really aren't interested in the retail portion of this business. This is Barrington Capital and Thor Equities. And like previous activist investors, they say unlock the value of this company's real estate, which they put a net worth of $9 billion on.
Yeah, and they say it'd make much more sense for Macy's to rent back the property, for instance, at Herald Square.
Yeah, just leasebacks, yeah. Yeah, we'll see. Interesting, too. I saw an interesting story last week. They sold out one of their big buildings in Brooklyn. A big, not necessarily a flagship property, but that actually fetched a much lower price than what some people had thought.
All right, third on the docket is Rupert Murdoch. The media mogul lost the fight to change his family trust and give sole control of his media empire to his eldest son, Lachlan. That was not successful, and this is according to the New York Times.
Yeah, of course, this is the drama that's been playing out for quite some time as we try to learn kind of what the new leadership of this company is going to look like. All right, one other person that we are keeping an eye on, of course, has been Bashar al-Assad, the longtime Syrian president. We now know has fled to Russia as his government falls to opposition groups. It sent shockwaves through the Middle East and, quite frankly, around the rest of the world, too. Tina Fordham joins us right now. She's geopolitical strategist and founder at Fordham Global Foresight. This was kind of one of those downfalls, Tina, that seems like it was a long time in the making, but still kind of sudden to a certain extent as well. I guess the big question right now is, what do we know about this opposition group that, at least for right now, is in charge?
Well, the opposition group has been at pains to reinvent itself in recent weeks, but in fact, they come from a group that is on US, UK, and EU terrorist groups. So it isn't going to be so easy to pivot away from that image, and I think furthermore to restore or bring unity or calm to a country that is deeply traumatized after 50 years of the Assad regime. We're only beginning to understand the scale of the inhumanity and deprivation there.
We talk about 50 years of that regime, and then you look back just over the last 10 years or so of all the infighting, and really how Syria just became kind of this proxy battlefield for so many people with so many different interests, whether it was Russia, Turkey, Iran, and a lot of folks in between. And I guess it raises the question, is there a future for this country that it isn't still just a proxy for another country like a Turkey?
Well, I mean, there were better days in Syria, but as you suggest, it has been a theater involving many of the actors that are also involved in the Russia-Ukraine war. Russia has its only Mediterranean port in Syria, thanks to its support for Assad, or had it, and a military airfield. Iran involved, Turkey with interest because of the Kurdish population there. So, a lot of cooks involved in that soup, and the Syrian people paying a very high price. But because it's not an oil-producing country, the turmoil in Syria didn't move markets, but we're about to see the second and third order effects of what's happening in Syria.
Right. That is a good point here. Tina, I guess my question in all of this is, this was a surprise to so many of us, and yet it feels like there was just silence out of the U.S. in response. We know that President-elect Trump did tweet that Syria is a mess, but is not our friend. But beyond that, it's kind of crickets. Where is the current administration, Joe Biden, in all of this? And if he were to speak, what is the U.S. position on this?
Well, you're right that there hasn't been much said. I did see a tweet coming from the White House that has attempted to link Assad's fall with Biden's policies. In a way, though, this isn't fair, because in geopolitics, things can and often do happen slowly, or nothing much happens. And then, as Lenin said, decades happen in weeks. And that really, for me, is 2024 in a nutshell. Decades have happened in the 52 weeks of this year, including now the collapse of this regime.
How much of the collapse of this regime in Syria is tied to people being unhappy with the incumbent? I mean, we saw it in Syria, we're seeing it in Korea, we're seeing it in France, we saw it in the U.S. We can list off the countries, but yes, this is kind of the story of 2024, out with the old, and we'll bring in whoever's next.
Well, remember that the civil war in Syria started 14 years ago because a number of groups and factions were unhappy with the incumbent. But as an autocrat, Assad had more means at his disposal and also took advantage of the patronage of Putin in Russia and the Revolutionary Guard of Iran to prop him up. So he was able to outlast for that reason. But the people in Syria have been unhappy with him for a long time. There's rejoicing in Lebanon as well. You see, cars coming back, Syrian refugees in Turkey, in Germany, and Europe returning to Syria. But what they have to return to is a bigger question. We know how this can go wrong, these transitions. We saw in Iraq and Libya, but those countries both had revenue sources in the form of oil. It's not clear what Syria's future can be, and also the historical cases of people who have been so divided against one another, then coming together in a kind of a national unity government. Well, there aren't very many cases, in fact. It's very rational to fear people who put your family in jail, tortured, and murdered them.
All right, Tina, always interesting insights out of you. Appreciate you taking time for us. Tina Fordham, geopolitical strategist and founder at Fordham Global Foresight. A discussion here about the future of Syria. We talk about what has now been a 13, 14-year civil war. I was just going through the numbers, official tallies. At least 500,000 people killed in this, 10 million displaced, and those are just the official tallies from the United Nations. Most people assume those numbers are a lot higher.
Yeah, and with a power vacuum that's now a result of this ousting of al-Bashir, you wonder what that means for migration patterns, not just in Europe, but eventually to the U.S.
Absolutely, too. And that gets to the whole point, too, about an economy that's basically cratered by about 90%. That's a brain drain, and you don't necessarily get that back easily. All right, we are keeping an eye on that, and we are keeping an eye on some of the potential market-moving events over the next 24 hours. That discussion after the break, right here on Bloomberg. Let's take a look at some of the potential market moving events over the next 24 hours, and we start in the interest rate monetary policy space.
The Reserve Bank of Australia will be holding its interest rate decision at 10:30 p.m. tonight, so we'll be covering that from our Asia programming.
You're going to stay up for that?
Oh, yeah.
Absolutely. Here, also at 6 a.m. Eastern time, bright and early tomorrow, we get a read on small business optimism.
Yeah, and it'll be interesting to see whether people think that the slowdown in inflation is going to be something that gives them a little bit more hope.
And this gets to this idea of kind of a tale of two economies. You have certain companies, larger companies that seem to be doing well and thriving, mid and small size companies, still a big question mark.
Absolutely.
All right, we all are going to get some earnings as well, so maybe we get some more clarity, including before the bell, AutoZone.
Yeah, AutoZone is going to be interesting to see what kind of demand there is for parts and car parts, especially as people are saying that the actual sticker price of cars are now too expensive.
And then after the bell, we get two interesting ones. I don't know if we're going to get earnings, but we are going to get a report out of GameStop.
Yeah, I'm predicting that there's not going to be very much commentary on GameStop.
Yeah, their releases and their conference calls have been decidedly short. Dave and Buster's also out. Full breakdown of all that coverage right here tomorrow on The Close. In the meantime, all your politics coverage is up next at the top of the hour, right here on Bloomberg.